This is the opening, and they started rallying it, ran it above relative equal highs. So there's buy side liquidity resting above that. What has my bias been for equities? Bearish. When we're bearish, it's likely to create a run on buy stops or buy side liquidity prior to a respectable decline that's tradable. What do I mean by that? These buy stops, they were purged. Seeing it happen live, it's scary. You don't want to short it. Many of you would look at that and say, there's no way I'm going to step in front of that and go short. When in certain instances, it's really the best thing to do if you understand what you're looking for. On the low end here, we have this low here. So there's sell side below here and buy side above here. So that's liquidity. So we're looking at the 5-minute chart, and I'm going to flesh out some things here so that way you can see it. All right, so here is the opening at midnight. This is what I've been teaching y'all right there. Overall, we had a consolidation in here. The market drops down in London, creates an intermediate term low. Then we rally up ahead of 5 a.m. and then we consolidate going into 7 o'clock in the morning. Then we have a retracement lower, drops down into post 8:30. Now here's 8:30 right there. Okay, so that candle right there is 8:30. The opening price on that, draw that out in time. Are we rallied above that? Yes. We are also above the opening price at midnight. So we are in a premium. Plus, it rallies above the relative equal highs here. So there's buy stops resting right above here. So now think about what's happened. We have a market that we've been bearish on. We're expecting lower prices on the index futures, E-mini S&P, NASDAQ futures, and Dow. We don't just simply go short because we want to be short. We have to wait for the market to go into a premium. Premium is where the market's going above its recent dealing range, equilibrium, or it runs into buy-side liquidity. Buy-side liquidity is above relative equal highs. So retail ideas would see this as a short-term area of resistance. What I train you to see is this is exactly where smart money wants to see price go. Once it does that right there, when it's rallying high like that, it's taking in all the pending buy stops. Why is there buy stops there? Because traders that went short, they are protecting their short with a buy stop there. Traders that don't know necessarily what to do, they'll see this area as resistance, but hey, if it goes up and breaks that, they're a breakout trader. So what do they want to do? They want to buy on a breakout. So that creates this pool of liquidity for the basis of buy side liquidity. When it rallies up above that, that is taking in a flood of buy orders. All these buy stops become a surge of market orders of buyers flooding the marketplace, which is exactly what smart money wants, because they want counterparties to sell short above at a premium high price. Now here's where this idea of smart money really resonates with people that know what's going on. This rally up here, this was not the result of buyers. This is an algorithm running price, and it starts spooling. No matter how many people come in and sell short, this is still going to go up here. That's the way it is. In these instances, there's this small little time periods where the market just simply does something that it's designed and programmed to do. It's going to go up here because when price was moving sideways like this, the algorithm was holding price like that. It's operating on time and price. So when it creates these little areas of small, smooth resistance levels, small, smooth support levels, the market finds a way always to come down and up to those areas and clean them out. Once we have an opinion or a bias that the market's likely to go lower and it rallies up to an area like this, smart money comes in and sells short to these buy orders that are resting right above these relative equal highs. So actually what is happening here, there's two things occurring. The algorithm that delivers price, no matter how many buyers or sellers that are coming in the marketplace, the price algorithm keeps offering higher and higher and higher. It's not necessarily buying or a lot of buying that's drawing price up on this candle. It's just marking to market the transactions that are being forced into because of the algorithm constantly pricing higher. Look at a lot of the retracements that happen real short and sudden. They don't happen with a lot of volume, not all the time. And that may or may not, I'm not going to co-sign on it here, that may or may not confirm what I'm suggesting here. There's other ways to confirm what I'm suggesting. It's simply just back testing it and you'll see it. But this rally up, once it takes this liquidity into the marketplace, it literally grabs those buy orders by the hair and yanks them into the marketplace. Those orders that are sitting here pending, those buy stops are now flooding the market in the form of buying at the market. And they're just out there screaming, waiting for a counterparty. Someone that wants to take the other side of that buy. They want to sell. Who wants to sell? Smart money does. They're looking for where the algorithm's taking price. They're anticipating this whole run here. They may or may not be in this buy, but they will be going short here. Then once they do this, if they're going short, once this flood of buy orders become market orders to buy, that gives smart money, the entity that's going to go short, that gives them an enormous flood of counterparty liquidity. They have willing buyers at a high price to sell to. So those buy orders, they may be putting people net long on a breakout, or they may be neutralizing in a loss on short holders. So if they're trying to take the buy stops here and use that as a way of facilitating a short position, using their mentality, they have to have a counterparty pool of liquidity to get out in. Where would that be here? In the form of sell stops, right? Where is that? Below this low here and below that low here. Why this low? Well, this was the low in London. Plus, if you look at this low over here, isn't this relatively equal? So people are going to see that as what? Retail support. So they're going to put sell stops right below here. Why? Because someone's buying and selling all the time. So this rally here, it's natural to assume that the sell stops would reside right below that low. That this is where a trailed stop loss would be on longs, and above here, buy stops would be placed for shorts or breakout artists. Right there, smart money has onboarded with shorts with these buy stops. They offset that short position with sell stops here and below here. Then what happened? The market goes back to a point of equilibrium between the high and the low. Once it does this, it becomes a 50-50. It could go either direction now. Now, with that said, let me go back and add the trade executions that I did this morning. This was my entry, 42.23 and 3/4. I sold 3 hypothetical paper traded, took one off here because we closed in this imbalance. It might have retraced a little bit before it went another wave lower. Then it went below here. I took partials there, one, and I took another one off here. So I want to take you into this little area here and show you what I was using for the entry, because I know some of you are like, can you just get to the point? How'd you know? How'd you know that that was an area to enter at ICT? All right, so we're in this little area here. I'm going to drop down into a 1-minute chart. Swing low, see that? We traded down below. Let me take this off because we've already accomplished the method by getting to this area. So we have the fair value gap I've been teaching you in this mentorship. So I was waiting and watching to see if the price on this candle, as we were drawing up into it, I wanted to see if we would stab up into 42.22. So as it rallied up into that, I sold short, and I was aware of the imbalance here. And as we traded down and closed that in, that's where I took one partial off there. Then I took another one off below the relative equal lows. Remember what's below that? Sell stops. So this is inducing a flood of sell orders at the market. So a sell stop, when the market trades there and marks the market, that sell stop becomes a market order. I'm doing what smart money does by trying to sell short above an old area where buy stops would be. And I'm also selling it right at the point of the best timing with price. Time, as it goes up into this area here, I'm not fearful that it's going to run this high. But what happens if it does and it hits your stop? Then I had a losing trade. How's that for logic? I'm going to show you if we go into, let's go into the seconds. Okay, I'm going to go into the 15th second and show you the candle I entered on for the purposes of timing. Even on the 15th second, I'm on that candle there. Now watch, I'm going to go into the 5-second candle. Even on the 5-second candle, I'm in on that candle right there. So I'm waiting for something very specific, and you can't get any better than that except for selling it at the very high, which I'm off by one and a half handles from the high.